A key part of knowing how to buy stocks involves finding the optimal place to initiate a new position. If you're familiar with the IBD way of investing, then you probably know about proper buy points. Ideally, we want to make sure we're buying as a stock breaks out from a buy point of a base, such as a cup with handle, double bottom base, or flat base. There are also add-on entries, like buying a stock as it bounces from the 21-day line or moves above a 3 weeks tight. But since waiting for a traditional chart pattern entry can mean getting in after a good part of a stock's advance, we also have early entries. When looking through chart patterns, you may find yourself saying, if only I got in back here, or imagine if I got in earlier. While nailing the bottom every time is impossible, early entries can help you split the difference between buying at the absolute bottom and buying as the stock confirms strength by breaking out from a traditional buy point. Downward sloping trend lines are one such entry that you can use to buy shares in the early stages of a powerful move. Trendline entries work best with stocks already forming proper bases. They can be found by connecting a stock's recent highs as a stock pulls back. The more points that your trendline touches, the stronger that entry point is. Ideally, you'll need a minimum of 3 points to connect your trendline. Often, the first is the base's left side high. If the stock crosses above your trend line, that could be a signal to buy, especially if that move occurs in heavy volume. Here's an example of residential and commercial builder Taylor Morrison, which peaked at the end of 2021 alongside the broader market. When looking at a weekly chart, you can see the stock formed a large cut base throughout 2022 and broke out from the 35.51 buy point in February of 2023. But savvy traders could have connected the lower highs within the base back before shares broke out in November of that year. That would have yielded a much lower entry near 27.50. And on the daily chart, heavy volume accompanied the move as it cleared that level. Another type of early entry that you can use is the horizontal line, drawn at a key resistance point that's lower within the base pattern. This one works similarly to the downward sloping trend line, except you're using a notable level of resistance within the current base or even a prior base. Then from there, you're drawing a straight line to give you your entry point rather than a downward sloping line. So going back to our example of Taylor Morrison stock on a weekly chart, each of the points where the stock attempted to rise but was pushed down by sellers gives us a new point of resistance. Here we can draw a horizontal line to find the next possible early entry. On this chart, there are at least 2 clear horizontal lines to be drawn at around 29.44 and the 32.85 level. Finally, there's the reversal, which offers yet another possible early entry. Upside reversals tell us that there is solid demand for shares, and these are a positive thing to see happening with the stock in general. And sometimes this action can also provide an early entry. An upside reversal occurs when a stock sells off, then bounces back and finishes higher on the session. A stock may open lower on disappointing earnings news or a downgrade, but battle back to close well in the upper half of its trading range within the day. This bullish action is even more positive if heavy volume accompanies the move. Upside reversals are a signal of strength in times of adversity and are especially notable when they occur at key moving averages, such as the 50-day or 200-day line. Reversals can happen in one day or over the course of several days, so be sure to look at the weekly chart as well as the daily chart for this signal. So for this example, we'll travel all the way back to 2007 with SunPower. A January breakout from a cup with handle base sparked nearly a year-long run in the stock. Traders who maybe missed the stock earlier in the move were presented with another chance to buy in August of that year. After pulling back to the 10-week line, shares found a bottom at around 60, which provided a level of support. On the 3rd week of that pullback, the stock started to reverse higher, closing at the high end of its trading range for the week in an upside reversal, with a solid closing range of 91%. Not only did the stock reverse higher, but it also closed above the 10-week moving average. The daily chart also shows strong volume the day it cleared key moving averages. From there, the stock moved from the high 60s to over 160 in the following 10 weeks. So to summarize, we don't always need to sit around and wait for a stock to break out before getting in. Just be careful. Early entries at times can be more aggressive, so make sure that you manage your risk accordingly. It may be smart to start a small position just to sort of test the waters at an early entry, then add to your position as the stock confirms strength with a breakout. Again, 3 early entries that you can use are the downward sloping trend line, horizontal trend lines, and reversals. These all provide great ways of starting your position earlier, and if the stock pulls back, then you're left with a bigger cushion to brace for the fall and you won't get stopped out as easily.